Hi guys, welcome to another video. Today we're going to be taking a close look at McDonald's company. Honestly guys, I've been analyzing quite a lot of companies lately as they really started to become interesting to me, and McDonald's not only caught my attention because of the sell-off that had been suffered, but also because I wanted to see if this company is in a position where it can actually overcome this global situation quite easily. And when I started to look at the data, it really got interesting, so I thought it would be worth it to make a video and share my thoughts on the company's analysis. And for this video I'll give much more relevance on quantitative analysis, as we all know the McDonald's business model pretty well. So starting with some basic analysis, you can see that McDonald's has experienced a massive sell-off, trading about $160 per share, contrasting with that $200 in February 2020. Also, you can see that the average PE ratio from the past 6 years is about 22, and the forward PE is just about 18.69, which I think it's quite realistic due to this overall situation. I mean, it's obvious that this company is going to suffer quite a big hit in the times ahead. However, let's make some calculations anyway. And also, I wanted to say to you guys that when you are analyzing a company with purpose of investing in it, you should look at the past performance to see if the company is both trading at an attractive price and capable to face any upcoming problems that may surge like this one. So if you look at McDonald's revenue and earnings here, right away you can see that the revenue has been declining, so not a thing that you're looking for, but the earnings have indeed been rising. So from here we can conclude that McDonald's on one hand has been selling less, but on the other hand it has been optimizing its profit margins, which is very positive. So it's quite a mixed feelings, as we're looking for uptrends on the revenue and expecting a stable profit margins, but in this case we have an uptrend on the profit margins and a downtrend on the revenue. Anyway, I think that's not concerning at all, given the McDonald's business. So if we do some basic maths to try to find the intrinsic value of the company, and I have to say that I'm just considering past performance to make my assumptions, so we actually can take the average of the past 4 years earnings. So and times this number by the forward P that I've showed you before, and we get what would be the market cap, and then divide it by the shares outstanding. So we get $135, and this is what would potentially be the fair value of the company. And McDonald's right now is trading at a little bit higher price, so I can say that for me to invest in this company with full confidence, I would be buying when trading below 135. And honestly, you could be arguing that this is quite an inaccurate price due to the fact that I'm not considering future growth, and that's fair. But with all this situation happening right now, I really can see McDonald's growing at least for the next year, if not performing worse. So I will stick with the past performance, as whatever estimates I make here, at least for the next 2 years, would be completely speculative and just betting on the future. So yeah, there are other things that I wanted to cover in this video, so let's continue. As I said before, we can see that the company is expecting to do worse. If we look at the forward PE, price to earnings growth, it's quite high, but I mean, with the 5-year range mindset, I think McDonald's is just going to do completely fine and actually can justify this price to earnings growth. Also, as I showed you in that little graph, they have been increasing the profit margin, and that's really good. But now I wanted to show you the main problem that I see in McDonald's business, especially during these times, and that's the balance sheet. If we take a close look at the balance sheet, you can see that McDonald's has total cash and cash equivalents of about $900 million, which leads them to a total cash about the same number, so $900 million, and a total current assets of about $3.5 billion roughly. And if we look at the total current liabilities, we can see that the company has a total current liabilities of about $3.6 billion. So from here we can see that the company doesn't have enough cash to cover all its current liabilities, And also, the company doesn't have even current assets to cover the liabilities. This tells me that the company relies on revenue to pay off its current liabilities, and that is not ideal, as it would be really better if the company had enough cash. But I mean, McDonald's, as a worldwide business, not be selling anything, or at least the necessary money to cover the debts in the current year, would really be not realistic. Even if people don't leave their homes, they can still order from home and take advantage of the delivery service. So for that to happen, it would have to be something mind-blowing that we really cannot understand. But yeah, this is by far the worst problem that I see in McDonald's. If we look at the cash flow statements, if we scroll down here, we can see that the free cash flow is about $5.7 billion, and actually this is very close to the earnings number, which is $6.03 billion. So this means that the company is not spending too much money to stay in business, which stands very positive, and that's the point here. I wanted to say to you guys that often the free cash flow is really a most important tool that you need to look at rather than the earnings, because often companies report huge amounts of earnings, and actually when you look at the free cash flow, they're not having that much money on free cash flow, and that could turns out on a really red flag for investors. So keep that in mind when you analyze your companies. Also, we can see that McDonald's has spent a lot of money in stock buybacks, spending about $5 billion, and actually this year a $15 billion program of stock buybacks was cancelled, and that really increases McDonald's free cash flow for this year, which leads them with more money to operate the business. Also, McDonald's is a very good dividend stock, paying its dividends uninterrupted for 45 straight years, and recently the CEO said that the payment of the dividends is pretty much a #1 priority for him, so really good thing to hear. As an investor, that means the company is giving it all to keep its dividends safe. And by the way, the dividend growth for the past 5 years of about 8%, so an absolute dominance over its peers. McDonald's is really a big company in this industry. And guys, I told you in the beginning of the video that I would really be focusing this video on the quantitative analysis rather than the qualitative, because we all know the McDonald's business pretty well. But actually I wanted to give a quick look at the management team, because I think this is the moment when the top executives have to prove their knowledge and experience due to this overall situation. And if we look at some details about them, there are some of these guys that are in McDonald's for pretty much 10 years or more, and obviously that increases the odds of success as they really know how to run the business, and that's very important. But honestly, I think for the price McDonald's is trading right now, if you buy the stock at the moment, you will get a pretty good deal. I mean, in the long run, McDonald's is just going to do completely fine, and that's pretty much my view on this company and what to expect heading into the future. Hope you liked the video, and if yes, please leave a like and subscribe. As always, do your own research before buying any security. Peace.